There you go. Good morning, everybody. Welcome to another event for the LIAFPN. Very excited that everybody's here talking about a topic that's very not well known in the industry, but I can tell you is very prevalent today, more than ever, as rising property and casualty costs are so high. And it's a very big field. And we're lucky and fortunate to have an expert, Paul Hyl, in the area of captive insurance. A little bit about Paul. He's an estate attorney, but this is one of the niches that he specializes in. I think he actually owns a captive company. He's going to tell you more about that. And hopefully, we're not going to have a huge crowd. If we have some time, we want to make this informal. And at the end, we'll do some introductions. So Paul, take it away, and I don't want to take away from your time.
All right, thank you. I could tell you were reading that because you said Hyl instead of Hill, which my last name's Hill, but you spell it funny. But when people are reading it, they just that Y throws them off all the time.
Oh, sorry about that.
No, that's all right. So yeah, I'm an attorney by trade, and estate planning was where I cut my teeth. And then, oh gosh, 7 or 8 years ago, maybe even more, I had 2 clients that happened to get into captive insurance companies for their businesses, and they got me involved in setting up trusts. And I said, well, let me find out more about this. What's a captive? And found out about it, the benefits of it, and started getting more and more involved. Got certified and dove into it. And now it represents at least half of my practice is helping business clients set up, establish, and maintain captive insurance companies. And Neil, you hit it on the head that it's really more prevalent now than ever. Actually, let me get my PowerPoint up here, right? There we go. There we go. You guys got it?
Mm-hmm. Yes.
All right. So, so we talk, when we talk about captives, we generally talk about reimagining business insurance, because of course a captive insurance company, or I like to refer to it as a private insurance company, is about businesses making a decision to start to insure some of their own risk. All right, whether it's risk that they were previously self-insuring for, that they're going to set up a captive, or it was that they're looking to move, some of their commercial coverage into their own private insurance company. Whatever they do, it's a very important decision because it's going to help solidify their business and make it easier for their business to weather downturns. And obviously, we don't have to look any further than COVID. In terms of businesses having downturns, a lot of times not covered by insurance, right? How many, business interruption claims were put in, and the commercial insurance policy requires either that there's a physical loss to your building, okay, which was not the case with COVID, or there was a pandemic exclusion on their policy, and so while many of business owners that had commercial business interruption weren't getting anything, business owners that had business interruption in their captive didn't have those exclusions or those limitations, and they were able to get the money to cover their loss. And whether it was the pandemic, whether it's the riots or the protests that caused damage to businesses and shut down maybe certain streets for a little while. These are all, a sign of the times. And there were many, I usually regale, and I won't do it today. I spend 5 minutes going over all the businesses that closed or downsized during the pandemic. Big name brands, right? Movie theaters, stores. Victoria's Secrets was closing a third of its stores, and I thought that was recession proof. My wife tried to keep them in business, but I guess it didn't work. They had to close some stores. So it's about transferring risk. Okay, now how do we transfer risk normally, right? We get commercial insurance, or we maybe have hold harmless agreements in place with our contractors or our vendors, but there's many other ways to transfer risk from your company to another company. Captives being one. People may have heard of risk retention groups. There's insurance pools. A variety of ways to do it. So the way we're going to talk about today is private insurance companies. Right? It is essentially a form of regulated self-insurance. Okay, it is an actual insurance company. There are premiums, there are claims that get put in. You have to maintain reserves. You have to be licensed by the insurance department of a particular domicile. There are about 35 states and territories in the U.S. That have a captive insurance legislation, and there's many more offshore. And insurance companies, including private insurance companies, are always set up as C corporations. And there's some tax benefits that insurance companies, including captives, are entitled to. And captives started with large companies. It was steel mills back in the 50s. Okay, that created captives because there was just a hardening of the market. They could not get affordable coverage out in the market. Right. So what did they do? They turned to their own creative uses, and they set up their own insurance company. Today, over 35% of P&C coverage is provided through captives. 90% of Fortune 500 companies have it. All Fortune 100 companies have it. There's really no segment of the business industries that cannot benefit from a captive. Last year's largest growth in captives was in the automobile industry, which is ironic for me because my first estate planning client that set up a captive that got me into it was an automobile dealership conglomerate here on the island. That was my foray into it, and so now that's one of the largest growing business segments for captive insurance. But your mid-sized businesses generally don't know about captive insurance. They rely on you guys as their advisors to explain to them or educate them about it and what it is. So let's look at how it tends to be set up. You have your closely held business, okay, owned by Jack and Joe, and they decide to set up a captive insurance company, and they are also the owners of that captive insurance company. Okay, so they own both. All right. Now, this can be structured a little differently in your publicly traded companies. Okay, it is the company itself that owns the captive insurance company. Okay, many hospital systems have captive insurance companies, and the captive is owned by the hospital system, by Northwell Health, or many large universities have captive insurance companies. Nittany Insurance is the captive arm of Penn State, and that helped them weather all the claims associated with the Sandusky scandal because they had built up funds in their captive insurance, and so that's owned by the university. So it can be owned by the individual owners if we're dealing with a mid-sized company, or if we're dealing with a larger company, it's owned by the business itself. But the business gets deductions for premiums. It transfers the risk to the captive, and the captive issues the policy and pays the claims. Okay. And captives used to be offshore a lot. Some of you may have thought they still are. That changed a lot after 9/11. There was a larger focus, of course, on money going offshore. There were a lot of states that started passing captive legislation. Congress passed the Terrorism Risk Insurance Act, TRIA, which required that you were a domestic insurance company to get the funding from the federal government if you were paying out claims for terrorism. And so captives can take advantage of that if they're a domestic captive. So there was a huge shift about 20 years ago to move a lot of captives into the US so that they would be domestic. And again, now there's 35 domiciles that do it, with hundreds or thousands of captives domiciled in the US. There's a misnomer out there. Sometimes people think, well, I'm going to shift everything to my captive. No, it's really, and the phrase I use is reimagining business insurance. It's about coordinating your commercial coverage with your captive insurance company. And so what you're still going to have catastrophic coverage over with your commercial insurance company, right? Stop loss or above the line coverage, whatever you want to refer to it as, but you're going to put your more manageable risks into your captive. Things that perhaps aren't going to have an extremely large loss, or things that potentially are not frequent claims. Okay? It's really about taking greater responsibility for your own risk. I'll give you an example. Hartford Hospital had a captive insurance company, and they had a loss because somebody came in with complaining of a stomach issue. They treated the stomach issue, and 3 years later, the guy died of lung cancer. And it turns out that when they took a diagnostic test, a chest x-ray, when he was in there was a lump on his lung that they failed to pick up because they were looking at the stomach issue. Okay. And they paid out that claim, and that came out of their own captive. It came out of their own pockets. So as a result, they focused on mitigating their losses. Right. So they now, anytime any tests get taken, they get sent out to primary care doctors, okay, or a specialist that might be treating the patient with a note about if anything was found on the x-ray to ensure that there'd be some sort of follow-up. Okay, so they did that to mitigate their risk because they were now on the hook. It's like owning a house versus renting a house, right? If you rent a house, it's not yours. You don't take care of it as much. You're not so concerned about the upkeep of it potentially, okay? Because it's like paying your premiums. You lose the money every year, okay? But if it's your own house that you own, you care more about it. What you pay is going to your own pocket eventually, building into the equity. Okay, so I use that as an example. The other example I use is, anytime you're using your own money. So when Neil and I go out for drinks, okay, if I'm paying, I'm going to get the 12-year-old Glenfiddich, right? But if Neil's paying, I'm going to get the 21-year-old, right? Because let's face it, I love a scotch that's old enough to order its own scotch, but it's expensive. So anytime you're using your own money, you're definitely more cautious about it. So what are the advantages of setting up a captive insurance company or a private insurance company? Well, we covered one, right? Focusing on your risk mitigation, okay? Also, providing coverage for risks that, were either uninsurable or just, not feasible in the commercial market, okay? When we talk about the benefits of captive, we usually talk about the 4 C's, cost, control, coverage, and capacity. So cost is, okay, you want to capture the underwriting profit, right? You may be surprised to learn that 35% of your commercial insurance premiums goes to overhead for the insurance company, right? Goes to naming the stadium. It goes to paying the commissions of the brokers. It goes to marketing and advertising, okay? You don't have that when it's your own insurance company. You also have access to reinsurance, which is cheaper than commercial insurance. Okay, so one of the advantages is that we help lower costs. Another is control, right? You have control over many things with a captive. We have some captives that have audit defense coverage, right? So the operating company takes out audit defense coverage from their captive so that if they do in fact have an audit, they now have the funds from the insurance company to pay the attorney's fees and the accountant's fees. You know how expensive attorneys and accountants can be. And so that may seem like, well, okay, people say, well, Paul, I'm just using my own money then, right? If I paid the premiums into the captive and the captive is paying back my claim, in that example, aren't I just paying myself my own money? And the answer is yes. However, okay, you probably weren't going to get that coverage on the commercial market because you weren't going to pay for it because you think, well, how often am I going to have an audit that I'm going to have to pay expenses for it? Okay. Well, let's say it's once every 10 years. Okay. And maybe your premiums are $20,000 for this policy, simple numbers. Well, over the 10 years, you pay $20,000 each year. And now you have built up $200,000 so that in year 10, let's say, when you have the audit and you got to pay $200,000 in tax attorneys and accountants fees, the money's there. And what did you do? You really balanced out your cash flow, right? You're not taking a hit out of you're not paying it off the books, or out of the books, I should say, off your balance sheet $200,000 in the 1 year you got that hit, right? You had the $20,000 set aside every year through the premiums to the insurance company. You couldn't do that on your balance sheet. Let me rephrase that. You could, though it wouldn't be tax deductible when you put it aside every year, as the premiums would be. And we know that not all business owners are good about, keeping a separate pool of money on the balance sheet for expenses like this. Okay, so it's control over that. Control over your claims, right? I had an apparel manufacturer who had their own captive, and they told me a story. They said, part of when we set up the captive, Paul, was, and I wasn't involved in the setup, but I've been assisting with the management. It was, we had a claim. There was a fire. We got paid out for the clothes. And then we learned about this thing called subrogation, and the insurance company, since they paid us for the clothes, took the clothes, they cleaned them and sold them to, a discount sales place without our labels on it to recoup some of the money they paid us. We don't want our product showing up on discount shelves like that. And okay, but the insurance company doesn't allow us to avoid subrogation like that. So when they insure in their own captive, they can control how the claims get handled. Okay.
So Paul, this is all tax deductible money, and it sits in a pool of funds, correct?
Yes.
And then what can I buy with that pool of money to minimize my risk?
So a number of things when we talk about minimizing your risk. Okay, one is you can certainly get reinsurance. Okay, so you might insure something in your captive and decide that although you're insuring your captive, you only want to take on the first $100,000 of risk. So you can then buy reinsurance. So the captive is getting its own insurance, if you will, to cover anything above a certain limit. The other thing, Neil, is that you can enter into pooling arrangements. Okay, so a lot of my captives, some of their policies may be just straight with the captive, and others, the captive might pool with a bunch of other companies in different industries, different businesses, even different lines of coverage, so that the risk is spread out among all the other companies that participate in that pool. Okay. Now, that scares some people. They say, oh, so if this other guy has a claim, I'm paying part of that because I represent whatever, 1% or 2% of the pool. The answer is yes. But if you have a claim, okay, you got 98% being paid by these other pool members if you have a 2% share in that. So it actually tends to be more beneficial than risky in the long run. I will tell you that the business interruption claims in those pools from 2020 were significant. And so that wasn't as good a year, perhaps, as other years in terms of underwriting profit.
Paul,
yes.
How are these pools? How are those pools set up? I mean, is it something that an owner can go out and select and become a part of, or are they just pulled randomly? How is that set up?
Yeah, so many of them are set up by captive managers such as myself, right? In that we took our existing captives and we put them together in a pool. But you also have the ability to sometimes join into pools that might be set up by other captive managers, right? So sometimes I may want to put a client into a pool with a different captive manager because, my pool might be smaller than theirs, and the type of coverage or the risk I see with them, I might prefer to put into a larger pool to spread something out like that. And that happens. It's sort of renting a pool, if you will.
Before they commit to something like that, do they see sort of a portfolio of where they're going in so they know what type of industries they're dealing with? Or it's left up to people like yourself?
Yeah, generally left up to people like us. It's more the other way around, right? It's the pool will do some underwriting to look at the captives and the associated operating entity, look at their risks and their loss history and things of that nature, but generally not the other way around.
Okay. Thank you.
Yep, you're welcome. And in fact, if you are a smaller captive, you need to enter a pool because there's some IRS rules about if you're going to be treated as an insurance company, okay, you have to have risk distribution, right? The insurance company itself has to make sure that the risk is distributed among a number of different entities. And so if the client that I'm doing the work for has, one operating entity, okay, their captive wouldn't be considered an insurance company if they only insured that one business. Okay, so that client needs to enter a pool so that at least half the premiums are spread out for risk purposes. Okay.
Can you buy life insurance,
No,
disability, long-term care?
you cannot buy life insurance, disability, or long-term care within your captive.
What products can you purchase?
Anything else?
Cybersecurity insurance.
Yes, general liability, medical stop loss, product liability, workers' comp, deductible reimbursement is a huge one in captives, right? I have one that's a nursing home conglomerate. They own 23 nursing homes. We set this up last year, and they were self-insuring on some of the homes up to $100,000 in general liability, right? So somebody gets bed sores, falls out of the bed, they were picking up the first 100,000 of liability. Well, in their captive, they put deductible reimbursement. So they're now going to get reimbursed from their captive when they have, the claims that they're paying out of the deductible. I have one I was working on yesterday. It's a commercial and residential real estate company in New York City. One of the exclusions on their commercial policies, and this was purposeful because of the cost associated with it, was tenant discrimination claims, right? Fair housing, you can't, discriminate based on race, religion, creed, sexual orientation. And there's been a huge uptick in those claims. And so there's been an increase associated with that if that's not excluded from your policy. So it was excluded from their commercial policy. They're going to be putting it into their captive. All right. Mold is another common exclusion for building owners, right? And that was excluded on their commercial coverage. They're going to put it in their captive. So pretty much on property and casualty side of things, anything you can insure in the commercial market, you can insure in your captive. And in fact, even things you cannot insure. When telecommunications, when satellites were getting put up back in the 80s a lot, you couldn't get commercial coverage for your satellite, okay? Because the market wasn't ready for it yet, didn't know how to price it. Those got put into captives by the large telecommunication companies. Early days of cyber coverage, larger companies had it in their captive because it wasn't yet being priced into the commercial market. So not only do I say anything that you can insure commercially, but even things you may not be able to insure commercially, as long as it's an insurable risk, right, and not strictly a business risk, you can insure it in there. Loss of key customer, loss of key supplier, those can all be in there. But again, not life or disability. So industries here, we talked a little bit about it. This is actually from 2019, so it's not the updated 2021, which just came out. I apologize, they're about a year behind in getting out the numbers. But I told you automobile was huge last year. But you see, it's any industry can probably benefit if the business is large enough, right? You have to be able to support the captive. So let's so let me skip ahead a little bit. What type of client would benefit from a captive? Well, they have to have risk, right? And they have to be able to afford to pay for that risk. We start off saying 20 million or more in gross revenue. Now, I do have some clients that have less than that. I've got an orthopedic surgeon, okay, whose gross revenue is about 9 million, but their profit, is about 5 million because it's a good spread profit margin, and they've got significant cost on their medical malpractice that they wanted to push over into a captive. They want to start self-insuring a good chunk of their medical malpractice because they feel that they're very, they haven't had claims, they're very safe. And on the other end of the scale, I have my car dealer conglomerate that I told you was my first foray into the business. Their gross sales are approaching $1 billion a year. Now, of course, the cost of goods sold, okay, is 900 million, right? Because the profit margin there is much smaller than on the doctor example. So it's not a hard and fast rule of 20 million or more. You could have companies with much more than that that really couldn't benefit from a captive. And they've got to be spending, a significant amount on their existing coverage. Okay. You may have heard that the IRS has been cracking down on captive insurance companies. And that's usually what I hear from accountants sometimes. That's the only thing they may know about captives. The IRS doesn't like it. It's on the dirty dozen. That's true. First off, it's a particular type of captive that's referred to as an 831B captive. Okay, it's a section of the code. And the reason that those are under scrutiny is because if you have a captive that takes in less than $2.4 million of premium, that premium payment every year is 100% tax-free to the captive. Right, so your operating business is paying up to 2.4 million, taking a deduction for it, and your captive is taking in the 2.4 million and not paying any tax on it. Okay. Well, you can see where those who are looking to simply avoid taxes might look to set up a captive solely for that purpose and not for the legitimate business reasons and risk mitigation reasons that there are for setting up a captive. And there was a case last year. Kaler Land was the name of the company. It was a construction company with a bunch of affiliates. Before they set up the captive, they were paying about $50,000 a year in premiums. That's it, $50,000 a year. And they had some uninsured claims that averaged over the last decade before they did this. Their uninsured claims averaged about 60 grand a year, right? So they're paying 60 grand out of pocket for things that weren't covered. They're paying 50,000 in premiums. So what do? They set up a captive, and back then the limit was 1.2 million. That could be tax-free. Anybody want to take a guess as to what the premiums were that they paid their captive? Right, $1,199,000. Okay, and it was only after they started paying those premiums that they then had, a actuarial analysis done to figure out what the premium should be after they made the payment. And when you know it, the actuary came back that the premiums were $1,199,000 that they were insuring, even though they never paid anything more than $50,000 a year to their commercial carrier, and they only were having about $60,000 a year in uncovered losses. Right? They set it up only for tax savings. Okay, and obviously they lost at the tax court. Okay, and so it's those bad apples that have caused the IRS to crack down on this. What's interesting is that in the same year that the IRS added 831B captives to the dirty dozen list, Congress doubled the exclusion amount. So instead of 1.2 being the threshold, it is now 2.4. That happened the same year it got added to the dirty dozen list. So what does that tell us? That tells us that the IRS recognizes that this is a tax scheme for some people, yet Congress recognizes the benefit to businesses that they have a robust insurance plan to mitigate their risk and to allow them to weather, certain storms. Okay, whether those are actual storms or not. Okay, and so there's a desire for businesses to have captives, for them to have coverage, for them to be able to grow and be stronger. But there's a recognition that this was an area that was being abused. Okay, and I am maybe unique in the industry. I'm happy about it. Okay, because once we get through this and the IRS has cracked down, it's only going to mean that those who are in it for the right reasons are going to continue to have successful captives. And on my end, as a proponent of them, as a promoter is the word the IRS would use. We're going to weed out the ones who did it improperly, and there's plenty of them out there. Okay. So let's see. I skipped a few things. Let's see. How are we doing on time?
We're doing good.
All right. All right, so how does it work if we want to go through it? Well, the process is I get involved. I get calls from accountants. I get calls from business attorneys. I get calls from clients themselves sometimes. I get calls from commercial insurance carriers. I did 3 captives last year for nursing homes, and all 3 of them were referred by their commercial broker. Okay, and commercial brokers who recognize that captive is not a replacement for them, but it's really designed to coordinate coverages. Appreciate the need for captives. They don't want their clients to learn about a captive somewhere else. Okay, they want to be involved in the process, and so commercial insurance brokers will refer clients to me as well. And again, we're not moving everything to your captive. You're always going to have commercial coverage. So I'll get a call. We will, do some document digging with the client. We get copies of policies, copies of loss runs. We speak with them about their business, where the risks are. We conduct a risk assessment, and we provide them with a formal written feasibility study that talks about what captives are, how their business can benefit from it, and certain lines of coverage that they could probably benefit by putting into their captive. They decide they want to go forward. We then go ahead and engage the actuary to do actuarial work and price out the policies. We create the captive, corporate structure-wise with the particular state. We submit the application and the licensing, and after the client reviews the actuarial and the premium calculations and decides what they want to put in there, right? Sometimes we come back and say, okay, your premiums could be 4 million. And the client goes, that sounds great, Paul, but I don't want to spend that. And so we'll pick and choose certain coverages. And then they commence operations, okay? I stay involved as the captive manager because my clients are very successful at running their businesses, okay? But they don't know the first thing about running an insurance company, right? Nor do they have the time, or do they want to learn. Okay, so I stay involved. I make sure they comply with the regulatory requirements. I coordinate with actuaries and underwriters, and we do the claims administration. All that we assist with, and we help them out. At the end of every year, we examine how their policies were, whether or not they put in all the claims that they should have. Okay, I sometimes have clients who are reluctant to put in claims. They say, well, it's either way, it's our money, Paul. I say, well, but the point of it is to use it for the insurance that we intended it. So we got to put those claims in, pay back your operating entity, okay? And we do a new analysis for next year, actuarially, and we price out the policies, and it continues again, okay? You do not need to domicile your captive, is the word we use. You don't need to domicile it in the same state where you do business, okay? So my car dealership, or they're in New York, they're in Long Island, but their captive is not domiciled here. Why? New York does not want, although New York has captive legislation, New York doesn't want to talk to you unless you're a Fortune 100 company, right? They don't want to deal with smaller companies doing captives, okay? There's plenty of states who do, and it's perfectly fine if you have a New York operating entity that's in New York that sets up its captive in Connecticut, for example. Okay, that's a state that I work very closely with. Vermont is probably the largest. It is the largest in the country in terms of number of captives. Connecticut was the largest growth last year. They grew by 35% in terms of number of captives. I take some credit for that because some of them were mine. So, so you can set it up anywhere. Now sometimes, here's a good example. I'm working now with a residential insurance company that also does new projects, right? They've got vacant land and they continue to build. They are down in Georgia. And they said to me, Paul, we heard about a captive. It sounds great. We attended one of these, seminar series that you did, but our mortgage companies, okay, require that we have A-rated paper, okay, or let's say A+ rated paper on the screen here, right? So they need to show that they've got a rated insurance company that they're getting their coverage from. So how can we do a captive? I say, no problem. What we do in that instance is the insurance company that is A rated or A plus rated or whatever you need, they will actually be the company from which you get your insurance. Okay. They will then reinsure with your captive. Okay. So ultimately, your captive is the one on the hook, okay, to pay back to pay the insurance company, the fronting company. But you're getting your certificates of insurance from that fronting company that has whatever rating you need. Okay. And in fact, you may be deciding to leave some risk with the fronting company, right? So you might take it out a policy with the fronting company that's $1 million per claim and a $2 million aggregate, right? And then the fronting company reinsures to your captive the first $300 per claim with a total $1 million of aggregate. Okay, so if there's a claim for $300,000, the fronting company is paying because they're the one you're getting your insurance from, but your captive is then paying back the fronting company. Okay, now you might do that because you didn't want to take on the whole risk in your captive. You want to take on a smaller amount, but if the claims grew to be too much in a single claim, you wanted to make sure you had, a backstop in, the fronting company in this example. So that's one of the ways we structure it when we have a client that needs to have what we call rated paper. No questions on that. All right. The team around us. Well, no one person can do everything, right? So as the captive manager, we have attorneys, actuaries, auditors, underwriters, TPAs, right? We work with all of these different partners, investment advisors, fronting companies, as I said, and of course, we work very closely with the domicile regulators, the insurance department of the particular state. Just a comment about investing. Investing for insurance companies is vastly different than investing your personal money or investing a qualified plan, okay? Investing for an insurance company is about, having the liquidity when needed, okay? Laddering maturities in terms of, we know that certain claims are going to get resolved in the first year and have to be paid out. A larger percent might be in year 2, okay, and then slowly dwindle down, right? If you've ever sued because you were in a car accident, you know how long lawyers take. We got to generate our billable hours before we can settle a case. So, these things drag on, and that's another benefit here is that you're taking the deduction up front, but not paying out the claim until potentially years later. Okay, so you have to invest knowing that you're going to need liquidity at certain times throughout the years. Okay, and you can't be, all of your premium dollars can't be in risky, investments. Okay, you can get a little more risky when you're talking about your surplus, your reserves that you have for the catastrophic claims. Okay, so we certainly got to be careful who's doing the investing. Let's run through some clients here. So somebody asked about different policies we can do before, right? So here's that nursing home conglomerate. I told you they were self-insuring. They started doing more and more homes, so their self-insured amounts that they were paying for their deductibles grew higher and higher. And don't let 2020 deceive you. We set up their captive in 2020, so they hadn't paid out a lot of claims yet. As I was saying, claims take a while to mature and get paid out. So what did they do? They took a whole bunch of coverages. The largest one on there, you see, it was a $5.5 million premium. That was their professional liability incurred but not reported. What does that mean? Well, you don't have to file a claim right away. You don't have to file a lawsuit right away. You have a certain number of years to do that. And their professional liability policy was claims made, right? So if they had the insurance when the claim was made, that's when, the insurance company will cover. And again, they have this large deductible. So if anybody had a loss at one of their nursing homes in the last 6 years, okay, they could potentially still file a claim in a lawsuit. Okay, so this $5 million for them represented the prior 6 years worth of claims that could still come to fruition, where they would be responsible for the deductible. Okay, so that's why it was such a huge premium versus the one above it, 1.5 million. That was for the claims that might have happened in 2021, the new claims, right? So, and they put in, they had patient evacuation costs, business interruption, if there were legislative or administrative changes. Well, what's that, Paul? Well, all of a sudden, you've got to test all your employees for COVID once a week. That's an administrative change. It's a new rule that's going to cost you. Okay, well, that's what this coverage would pay for. Litigation expense, if they get sued, it's paying for the attorney, reputational damage, uncollectible receivables, so loss of key employee, medical billing errors. So the policies are sometimes consistent, so business interruption might be consistent across businesses, right? Deductible reimbursement might be consistent across businesses, but then you've got coverages that are specific to the industry, right? So here on the nursing home claim, it's patient evacuation, it's medical billing errors, okay? Different for, a grocery store chain that's going to have food spoilage in there, okay, as one of their lines of coverage. So, there's certain overlap throughout industries, but then there's others that are unique. We had a plastic distribution company. Okay, here their top line revenue was $340 million. They buy resin from manufacturers, plastic pellets, and they sell it to, the companies that are going to make water bottles or those plastic storage bins that you find in your big box store. And so they had different lines of coverage that they had on there. Okay, for them, they had a lot of key employees and key customers that if they lost would be impactful. Just a comment here, you see we have disability of key employee. I know you asked earlier about putting disability coverage in there. This is the extra expenses that the company would go through in finding replacements, maybe hiring temps, okay, or the loss of income on the company side. This was not to pay out disability claims to the key employees, okay? They had product recall. Okay, nursing home's not going to have product recall, but here the plastics distribution company would have that. And then here's one I want to show you. Oh, go ahead.
Paul, the overriding question is, so let's say I put away $2 million in this company. I'm just using round numbers, and I only spent $1 million.
Okay, that's
so
great.
I've got $1 million sitting in my fund, which is invested, and then I sell my company. What happens?
So when you sell your company, okay, you're not selling your captive. Okay, you're just selling your company, and so your captive at that point no longer needs to provide insurance. Okay, and you now wind down, right? Because you may still have some claims depending on when your coverages, ran through, and there might be a tail, as we call it. But at some point when all of your claims have been administered, you will surrender your insurance license. Okay, you no longer need to deal with the insurance department. You no longer need to do any sort of reporting. You'll surrender your insurance license. Quite often, that requires us to change your company name because your company name, when it's an insurance company, has the word insurance in it or risk management. But in most domiciles, you can only have that as part of your corporate name if you're an insurance company. So quite often we have to change the name, but your company then continues along as a regular, good old-fashioned C corporation. Okay, no longer an insurance company. The funds are in there. Now, how do you get the funds out? Right? Well, depends what you need them for. Okay, you don't need to get them out necessarily. What do you want to do? You want to buy more land, put up a new building. You want to acquire a competitor. Okay, you want to acquire a business in your supply chain. No problem. Your C corporation that was formerly your captive can just use its money to do that directly within the captive. Okay.
Gotcha.
Or if you decide you just want the money, to go gambling at Jake's 58, you can take it as a dividend. Okay. Pay the tax on it, and it is now your money in your hands. Okay.
Interesting.
Yeah, we typically when I set these up for clients, let me jump ahead. Oh, I didn't have that slide on here. Okay. Typically when I set these up for clients, I'm just confirming I don't have it. No, okay. I said before in the simplest example that, Neil, it could be owned by you as the owner of the operating entity, right? So you can own the operating entity and you can own the captive.
Right.
It is, but at that point, while it's operating as a captive, if you want to get money out because you want to do any of the things I said, acquire a competitor, new land, right? You can't do that when the money's in the captive because your investments in the captive are overseen a little bit by the insurance
Understood.
regulators.
Yeah.
So you want to get the money out, but you don't want to pay the dividend. You don't want to pay the tax on the dividend when it gets dividended out.
Right.
So we set it up sometimes that your captive is not owned by you, Neil, but it is owned by another entity, typically an LLC, that elects to be taxed as a C Corp. And then when the dividend comes out of the captive to the owner, which is this LLC that's taxed as C Corp, there is something called a dividend received deduction. Okay, when one C Corp pays a dividend to another C Corp, there's no tax at that point because it's still in a C Corp.
Right.
So that would allow us to get the money out of the captive while it's still a captive, so that you could use it to invest in your business without incurring a tax at that point.
Right. So the key here is, and not to get into too much detail, you know, nobody here except you, Paul, is probably going to be an expert in captives, and nor do we want to be, but we want to have that awareness of, we walk into a company situation and they bring up the word captive, or they're doing a captive, or just to have some knowledge and have a name you can call, a partner you can call and say, hey, Paul, tell me a little bit more about this structure. Is this the right thing? So you can be a knowledgeable, influential person and handle all their benefits and all their needs. And that's why we have Paul speaking today. I think knowing somebody who knows something about this specialty is very important, because there's a lot of P&C places that do business with me that are now coming across captives on a regular basis. And they're saying, well, what do you know? What do you know? Well, you know, my expertise is not captives, okay? But I know Paul's is. So I know I can bring Paul into the discussion to really have that right discussion, or they'll lose all the coverages that they're currently doing with the client. If their competitor is recommending something, they're going to take all the coverages at the same time. So you do have to have an awareness and have to have those tools in your tool chest when you run across the right situation on who to call. So Paul, I thank you for that. I only want to cut you off just so everybody can do a little bit of networking. And,
of course.
And if there's any questions, certainly. Larry, do you want to introduce yourself? Larry Bloom? And just to those who don't know you.
Yeah, hi, Larry Bloom, Bloomstone CPAs, board member of the LIAFPN. Our firm is in Jericho, and we work with privately controlled companies, most of them small business, a handful of middle market companies.
Excellent. Bobby Bird.
Yes, sir, Neil.
How are you?
Good morning. Thank you very much.
Good morning.
Doing very well. Doing very well. My name is Robert Bird. I go by Bobby Bird. I'm the newest, I'm one of them, the newest members of the LIAFPN. Proud to be here. I'm a advisor with RBC Wealth Management. I'm also in Jericho. And this is a very opportune call because I manage a captive on behalf of the client. You know, always interested in the idea and the topic and how to grow this part of the business. So I appreciate it, Paul, and I appreciate you, Neil, for putting this together.
No worries. It's all good. Thank you for being here. Teresa.
Hi, everyone. My name is Teresa Garzon. I work for iSolve. We're an HCM payroll HR company. So this was such a great topic, Paul. Thank you so much. Thank you, everyone. I'm on the board too. Have a great day.
Thank you. Larry Shear.
Good morning, everyone. I am a trust and estate and business succession attorney. Our firm is preparing not just estate planning documents, but we're working a lot on the elder law area as well. Paul, I missed a couple of opportunities which you brought to light, and in the future I will not. So you and I will be speaking at some point. Anyway, I am a co-founder of the LIAFPN, and thanks everyone for showing up.
Thank you. Larry Estridge.
Yes, I guess that's the hat trick with Larry's in the allotment.
I know
today. I thought that was a prereq. You had to be Larry. By the way, my daughter spelled L-A-R-I too. So Teresa, if you
That's
want
cool.
to change that name, we can do that. Anyway, I am with the DBL Center, which is based out of Melville, Long Island, and I joined them about 2.5 months ago. We primarily work with the other side of workers' comp. So it's kind of a good fit with what you were talking about, Paul, where we deal with the state disability and paid family leave, which is you have to have it. It's much like homeowners or car insurance. If you own it, you have to have it. If you have a business in New York, Connecticut, New Jersey has its version, you have to have it. So I think we can be speaking a lot regarding that. I come on to handle the work site because we work with so many businesses. We're already doing the state disability and the paid family leave. We can go in there and we can talk about the short-term disability, the critical illness. We do everything except for the healthcare side and the P&C side. Where we can also find some synergies, Paul, is the fact that I work primarily with brokers and of course, other financial institutions and the relationships that I've had. And P&C companies I'm looking at currently. So when Neil gave me the opportunity to come in and speak, listen to you speak, here I am. So
Oh, good.
I'll be reaching out.
Thank you.
There you go. Paul Feigenbaum.
Good morning, everyone. Paul Feigenbaum, Blue Ocean Law Solutions and Office of Mass Mutual. I'm an investment advisor representative, special needs planner with Mass Mutual. I work in areas such as elder care, retirement income planning, business succession planning, and families with dependents with special needs. And I'm not on the board or a trustee of this group. I'm actually a civilian. So thank you.
Civilian's good. Mr. Phil.
Morning, everyone. Great presentation. I was pleasantly surprised at how much I learned and was interested in the topic.
Well, thank you.
I'm not sure if that's a backhanded compliment or not, but it was meant as a real compliment. And as a CPA, I learned something new about tax today regarding the taxability of C Corp to C Corp distributions. So thank you for making me a little smarter this morning.
You're welcome.
In a couple of areas, that was great. Phil Kenyuk, CPA, well-credentialed in the areas of business valuation and forensic accounting, damages and such. I'm an exiting partner from Nussbaum, soon to be a new member and partner at City Levine in Melville, New York, full service accounting firm.
Excellent.
Have a great
And
day, everyone.
Thank you. Mark.
One of those things you have to remember to unmute yourself before you start
That's
speaking.
okay. It's all good.
So, I am Mark Badami. I'm a certified financial planner, and I work with Center for Wealth Preservation. I'm also the president of the Financial Planning Association of Long Island. And Neil, you did a great job putting this together. Paul, you did a great job presenting captives. It's a very complicated subject matter, and when you're able to put it in such simplistic terms, it makes it look so easy to sell these things. So you did a great job with identifying that.
Thank you.
I should mention a couple shout outs. Phil, you're going to have a great time working with Sally Levine. Those guys are great over there. I work very closely with Roger, Larry, and Frank, and also John Martisotto, who's part of their advisory, their RIA, is a member of our board at the Financial Planning Association. So I've been working with them for a number of years. A terrific group of people. You're going to like it over there a lot. They're very, very. My area of expertise is estate and business continuity planning. I do a lot of pension work. So when I started doing captives, I've done captives probably for about 10 or 15 years now. Our first captive was about 15 years ago. And that was when it was really in vogue and I'm sorry, not in vogue. And it was really like the accountants were kind of like, what are you, crazy? These things are crazy. And when they when it shows up on the Dirty Dozen, it makes it a little difficult to talk to accounting community, especially when you get most of your business from accountants. But you have to explain to them. And Paul, you did a good job putting it up to trying to put it in simplistic terms and say, listen, you know, Congress is in favor of these things. They keep on raising the limits, and people don't realize that Obama raised the limits to 2.4 million,
Right.
and that was not very favorable for a Democratic ruled Democratic administration. So when you look at like who's putting these regs out, and then look at who's challenging them, you should really weigh both odds before you dismiss it. And bring someone like a Paul to the platform is only going to help your cause to get you a good deal and get this case going. So I mean, I'm working on a couple of cases right now with Paul, and he does a fantastic job explaining just why it might want to make sense. A captive might make sense in the business. So Neil did a great job.
Thank you. So our next meeting is going to be on ESOPs. We have an ESOP specialist who's going to come speak with us in 2 weeks. Very highly respected, another niche specialty, tax favored treatment of corporations. And I think it applies to all our different levels of expertise when it comes to insurance, when it comes to legal matters, and when it comes to tax matters. We need to know about all these topics. And the biggest thing about LIAFPN is we have experts in every area of financial planning to use as your resource. And we encourage, to make introductions, to quality introductions. Larry Estridge, I want you to meet Robert Byrd. I want to do this after the call. But I mean, these are the type of things that drive business and also make us better and stronger for our clients. And that's the key. For those of you who don't know who I am, I think everybody does, but Main Street Planning Group is a fully independent wholesale insurance, fixed insurance, life, disability, long-term care. That's where our expertise is. We excel in underwriting and in product solutions. And basically, we're a solution provider to everybody. And hope you had a great day. Look forward to seeing you live at some point. But we are having another Zoom meeting. I'm not sure when our next live event will be. We may do another event at the Hilton, pandemic permitting. Thank you. Have a great day,
Neil.
everybody.
You
Neil,
take-
Thanks for having me,
Thanks for
guys.
setting it
Thank
up.
you.
Take care.
Thanks,
Bye-bye.
man.
You all.
Bye-bye.
Bye now.